Table. This week I'm joined by Jeff Yasteen, Roger Scott, Adam Sarhan, and Jeff Zandaniri. Gentlemen, welcome.
Hey,
hello. Thank you for having us.
You bet, guys. Good to see you all. And, this week we're kicking off with a bit of effusive and irrational exuberance in the market. At least that was 20 minutes ago when I last looked. What's driving the market sentiment today? Roger, let's start with you.
Well, I think we have to look at this week in the context of the Fed. We have a lot of news this week. We have the FOMC on minutes coming out on Wednesday, not the minutes, the actual FOMC announcement coming out on Wednesday to Thursday, 2:30. I don't know why I said 2:30. And usually the market tends to be, not this morning, but it usually tends to be fairly subdued going into the FOMC because we don't really, I mean, we can guess, but we don't really know what the Fed's going to say. So we tend to see volatility pick up as we get closer and closer and closer right after the announcement. But right now, volatility is really moving. I mean, the markets, last I checked, was really showing some strength, and we are off to the races again. But I would be very cautious, especially because there's a lot of Fed data. We have a lot of retail data, manufacturing data this week. I think this week is going to be very important for data. So I'm going to tread lightly, and I believe the market is entering a consolidation congestion zone that may be with us till the election or close to the election time.
Sure. Okay, Jeff Z, what's your expectation out of the Fed meeting, and are you making any strategic plans accordingly?
So the Fed has set up a expectation that they're going to be dovish forever. They're going to buy all assets. They're going to continue to support basically global securities wherever they're needed, whether it be treasury buying or corporate debt purchases. Some speculate that they're going to enter into equity ETF purchasing at some point. And so I think a lot of people, of course, they're not going to do anything with rates because they can't. But I think a lot of people want to hear that guarantee that, yes, daddy's going to be there for you forever. And I'm not sure they're going to give it. So there might be a surprise of them not being as mega dovish as they're expected. Anytime you have such an expectation in your mind that something's going to have to be so great and it's slightly not, it's like if you go see a movie that someone's like, best movie ever, or down here in Florida, if someone says it's real New York pizza, and then you go there and you're like, this isn't, no. The expectation level sets high, it comes a little bit short, you crush it. Same thing could happen with the Fed this week. I'm a little bit nervous about that.
Mm-hmm. So we saw the Fed announce that they were going to, be buying corporate ETFs, everything from junk bonds to top-rated debt, and then they set up all these special purpose vehicles. But week after week, this is the 8th week in a row where the Fed balance sheet has contracted, and none of these special purpose vehicles have actually made any significant purchases. So, the interpretation on the part of the sophisticated community is that the Fed tried to, get everybody buying all these bonds ahead of their anticipation that the Fed was going to be, writing checks into these different asset classes, which didn't happen. And so the junk bond traders tried to front run the Fed, not realizing that the Fed was front running the junk bond traders. And so thus we end up with this uncertainty, yet exuberance in the marketplace, because now these junk bond traders are long bonds that they thought they'd have an exit on the Fed. They don't. So what's going on? Is the Fed using has the Fed turned the tables on the market where they've now become fully cognizant of the power of their statements, and they're saying, well, hey, we'll put out this sentiment that we are going to be Big Daddy, and we are going to be the bank, the purchaser of last resort across all asset classes. We are going to be the floor on the market. And then the market responds by rushing in, increasing liquidity, acquiring assets, and then they don't follow through. And Jeff Yasteen or Adam Sarhan, what is the deal here?
Go ahead, Jeff.
Oh, gee, I have to go first on that. My head's going to explode, James, because it's like, man, there's so much there. After a while, it trying to anticipate, what the Fed is anticipating versus the institutions versus the junk bond guys. Like I said, it makes your head explode after a while. My view is, tactically, I'm just looking for whether we see a fade of today's bounce. The market opened higher. Are we going to see this thing kind of grind lower, which is my expectation, and just see the amount of bullishness that's waning bullishness that's out there on this, and see that sort of grind lower into Wednesday's Fed announcement, whatever their statement's going to be. My expectation would be that perhaps if we see a fade lower through that announcement, that then I would be looking to go long and do more on the long side coming out of that, just anticipating that perhaps we see some sort of a gap down Thursday morning, or we have a bad close Wednesday. And after that, I would look to go ahead and get long, because I think Friday is another options expiration. And I'm just going by instinct out there. I think that's what we're going to see. Beyond that, I try not to overthink it too much, just because I'm just looking for stocks that are going up, or options opportunities that are going to pay off. I'm not going to try to super anticipate this thing too much, because okay. I'm just a simple guy. I'm not going to think too far
okay.
ahead.
Great. And Adam, what about you? Do you think that the Fed talking up their asset purchases has catalyzed this sort of frenzy in the bond market? And is that something that you're concerned about?
So I'm a big believer of the Fed is the elephant in the room, so to speak. If you go back and study prior cycles, go back to even the 30s, when central banks were, doing the exact opposite of what they're doing now. They were tightening back then, and that not only led to the depression, but after the depression came out of it, there was another huge recession, so on and so forth. And the current Fed, since 2008, that major financial crisis, has done the exact opposite. They've just flooded the system with liquidity. And if you look back at every single rally we've seen since 2009, since the bull market started, the first one, if you will, since March of 09, it's been driven by easy money, or the expectation of easy money from the Fed and other central banks. And that hasn't stopped. Even now on March 23rd, when we had the bottom in 2020, it was because of the fact that the Fed came out and took out all the stops, said unlimited QE, and same with other major central banks. So for me, the Fed is the single largest driver of stock prices, also bond prices, but currency prices, commodity prices. It's the whole 9 yards. And also, you've got not just the expectation, but you have to understand how the market reacts to the news. So the news is important. Like Roger mentions, a lot of data coming out this week. I'm also watching earnings. We have stocks like FedEx, Adobe, Costco reporting this week. I think next week we have Nike, AutoZone, a few others. So we still have earnings. It's really trickled down now. Just a few stocks are reporting because it's the end of the quarter. And then we have earnings season again in a few weeks. So I want to see how the stocks react to the news. I want to see what the Fed does, obviously, what happens with the earnings data. But really, for me, I saw I'm still bullish, and I saw what happened in the last 10 days or so, a week and a half, that big correction as the market resetting. We were very overbought. Roger's mentioned it here on this episode many, many times. The numbers, percent of stocks above the 50-day moving average, above the 200-day moving average, any indicator you wanted to use in mid or really late August was off the charts, super overbought. And what happened the last, a week and a half, if you will, is that the market reset itself. So now it's pulled back to support, which is that 50-day moving average for the NASDAQ that we spoke about last week. It's now being defended as of right now. That could change by Friday, but this to me is a very bullish event.
Okay, so great. I mean, it's like, I struggle to understand what we should be doing. So, you look at the bump in the markets this morning. Is that driven by the fact that Oracle is going to end up being the partner of TikTok through BitDance? Is it because is it because Delta's buying back debt? I mean, all these different things are catalysts, yet there still is the persistent weakness that is part and parcel of the respiration of the tech market as it surges to new highs and then profits taken. But still, stepping back now, what are the collective net effects of, say, the coronavirus situation and everybody's fatigue of it? What is the expectation around the election? And what is the impact of that on what is happening now in the market? Should there be a modification to strategy to accommodate that? And then, Roger, I'm going to throw that whole hairy ball of wax over to you to start.
Not a problem. First of all, I just want to make a comment about something that you started this off with in regards to who's on first, who's on second, the Fed or the junk bond buyers. And the Fed, when you were talking about how the Fed is finally realizing that what they say has some value. And I just wanted to comment and say that you would think they would have figured it out about 20 years ago when Alan Greenspan did his whole irrational exuberance thing. But I guess they're slow to learn, you know. But I just had to throw that out there because you would think by now they would have figured it out, right? But they're still knocking their heads against the wall. But going forward, to answer your question, I think the market is. I think markets are always looking forward. I think the market, March, April, May, even June, I think the market was only thinking stay at home. What can we do now to deal with the situation we're in now? And that's why we saw such a big run up on the internet, the cloud stocks, the stay at home stocks, and so forth and so forth. In the last 6-7 weeks, we've seen a major reversal. We've seen a fading of the stay at home stocks, and we've seen a lot of the stocks that are the brick and mortar stocks like Gap, Nike, even the cruise ship stocks. I was looking at the gains over the last month. Some of the biggest gains were from the cruise ship stocks. So am I saying that's going to continue? I don't think so. But I think right now, investors are really sick and tired of the COVID-19 stay-at-home environment. And they're looking for anything possible, and they're looking as far into the future as they can. At the same time, you have a group of investors who are becoming more and more defensive and taking money out of the stock market. So you have two things happening right now. You have some, and I'm going to say profit taking because we're near all-time highs. Usually I say loss taking, but in this case, I think we're seeing some profit taking from the investors and traders who have been long the tech stocks over the past two quarters. And I think you're seeing some hesitation from new buyers to get into that because people are looking forward, investors are looking forward, hedge fund managers are looking forward, and they're starting to see the light at the end of the tunnel, or at least want to see the light at the end of the tunnel. So you're seeing a slight change in the environment, moving into defensive stocks, moving into retail stocks, moving into the stocks that we all knew and loved before the COVID cycle began. And I think that may continue unless we hear some really bad news from Pfizer or more bad news from AZN, stocks that are literally, that we're sitting and waiting for them to come out with that magic pill that will help us get over COVID-19. I think if you look at the broad market and if you look at each individual sector, I think that's about as clear as day that this has been going on. And that's where the outlook is heading right now.
Jeff Z., how are you anticipating dealing with the confusion?
How do I deal with confusion?
No, I mean, the confusion inflicted on the market by the uncertainty surrounding, the coronavirus.
I don't think the market's confused. I think that the market does what it always does when it overreacts in one direction. It swings back violently and it catches the late people to the party by surprise, and it hits them because you know what? Stonks don't always just go up. They don't always just keep exploding. I've been here as a proponent of trend trading and trend following, and I've said, you have to keep playing this until it stops working. Well, then it stopped working. But my anticipation is that the same people that loved buying those stocks are going to do it again. They're going to do it again because the underlying environment for them to do it, as Adam Sarhan was so eloquently saying earlier, has been set up by this buoyant Fed support. What else are you going to do with money? How many of us have money that's just sitting there doing nothing because we're nervous, because the economy's weird, but you can't get any yield? And I don't want to chase that stock. We all have stocks, but we all have cash. I'm not all, but I mean, a lot of people I know. And then there's that conundrum. So what do you do with money? You get no yield anywhere. You can buy stocks for dividends. That's intelligent, but you're forced to buy equities basically right now in some shape or form, or gold, which I like also, but you're being punished for having cash. One thing I'm keeping my eye on is that the margin in the election between Biden and Trump is shrinking. And I saw this weekend this big news story that not a lot of people, I mean, it's a big news story politically, but it's not so big in the market, but I've been paying attention to it, that Mike Bloomberg is going to throw $100 million in to compete with Trump in Florida, where Biden was winning by 6%. And now it's down to neck and neck. And so for me, That's, Florida's a big swing state. It's a very important state in the Electoral College. If the writing on the wall that the Biden camp is panicking about Florida and they need this big donation of money so that they can advertise and compete with Trump, then that's a sign that there's momentum happening in the rest of the country too. And I think if Trump starts to look like he could possibly win, which the market has kind of been a little bit skeptical of, I think that could be a huge booster for stocks.
Hmm. Hmm. Yeah, it's interesting. My brother just arrived here at my farm in Southern Ontario. He drove across the country from Portland, Oregon, passing through Wisconsin, North Dakota, Michigan states, all very important states and all very Trump focused. He reported that across the whole country trip, he didn't see one Biden sign. He saw plenty of Trump billboards. So you hear that, and I think of Trump support is not really that responsive to competitive advertising. There aren't a lot of fence sitters when it comes to Trump. Most of Trump's base is dedicated, determined. You could not pry them off of his vote with a crowbar. And so that's interesting because it's like we know it's going to be a close vote.
It's like a panic move, though, is what I'm saying. I read it as something like, oh my God, we had this in the bag and now we don't. And we have a shortfall of money that we can spend. And so you have an individual donor that's coming in and filling that hole with a sizable donation of $100 million. I mean, I was at a conference in Palm Beach a couple of years ago for one of these large investment banks, private clients and hedge fund clients, et cetera. Mike Bloomberg was at the conference and he spoke. Everybody had to turn their cell phone off. You couldn't take a video of it. And he ripped into Trump. He has an unabashed hatred for the guy, and he was cussing, and he was very emotionally a believer that this guy needed to be removed from office. So I know that he's not like somebody that he's been in the shadows of trying to get this guy kicked out of the White House for a while, but they're concentrating now. This knee-jerk move now tells me that things have changed. Things have changed because they weren't talking like that or thinking like that a month ago, 2 months ago. It was a given that this president was going to go, that he mishandled Corona, and this country is suffering, and it was obvious to everyone, or so it seemed. But now it's not as obvious, and if it becomes even less obvious, I actually think that would be positive for stocks, because the thing, and this isn't a political statement. This is just a fact that the proposals I've seen from Biden, and the most debilitating one, is a huge tax on stock investors on long-term capital gains. The corporate tax is going to be raised, but the punitive one, for the one that people are going to front run to take profits on, would be that huge increase in capital gains. None of us want to see a 5% or 40% taken out of capital gains in some of the winners we've been sitting on. What would happen if he gets elected? You're going to see a run for the exits in the short run. I think it's something you play, but I think that that's something that investors are handicapping.
Sure. Interesting. Well, there's an interesting question which I'd like to present to the group here assembled, and I'll start with you, Adam, is without sort of having to reveal any sort of political bias, to what extent would the threat of a tax on, or an increased burden of tax on long-term capital gains affect your vote?
I think Jeff Z's right on the money, James. If you look at the polls back in 2016 when Hillary was winning by a landslide, I think we mentioned this before. In the debates, the last moderator asked Trump back in 2016, "What are you going to do when you lose?" And not only did he win, but he won by a huge margin. And I think that's what happened. The same thing's happening now. So to answer your question, Biden wants taxes to go up. Trump wants taxes to go down. Well, what's better for the economy and for Wall Street? It's for taxes to go down. Why? Because that creates more stimulus. It helps an economy that needs help right now because of, a big portion of it is shut down, and or a lot of people are suffering because of coronavirus and the impact on their industries. And, look at the travel and look at the restaurant, the servers, all those kind of people, even Disney World and all the entry-level jobs or service-based jobs. They're not there anymore. I mean, people just aren't showing up and going and spending that money. Games, we spoke about sports before, the arenas are empty. And think about all the ramifications there. So you've got a big portion of the population that can't afford to pay more taxes let alone, even think about it and what that'll do for the other people and so on and so forth. So I think there's no question here that A, Trump is going to win, and B, the market, once it realizes that, will take off. And that kind of another reason why I'm bullish here. Plus, you've got easy money from the Fed, and you've got more stimulus coming, and a possible coronavirus vaccine, like the CEO of Pfizer mentioned over the weekend. By the end of the year, we should have a vaccine, and we should be good to go. So, and a lot of those coronavirus stocks have been under pressure over the last few weeks, and they're all bouncing and bouncing sharply now. So, putting everything together for those reasons is it strengthens my bullish case.
Sure. Okay. Jeff Yestein, do you share Adam's sentiment?
Yeah, I have to say, it doesn't really matter to me as an investor which side wins the White House. I think it's more important in terms of which side ends up controlling Congress, or if we have another, split situation like we do now. Overall, I just go back to like something Roger spoke about regarding the stay-at-home stocks. I saw an interesting thing regarding, think about it in terms of quarantine versus recovery. And the recovery stocks are in large part the value stocks, if you will. And if you just focus on those, like Roger mentioned, the cruise stocks, I've been talking about those for a while now since I've been here, and they're up, 18, 20%. The airlines are starting to do nicely. Banks have not really started to move yet, but they haven't really gone down either. If you look at like the NASDAQ bank index. So if you focus on those are the places where the value is, regardless of which side ends up winning this thing. At the bottom end of this, we come out of this pandemic, those are the stocks that are going to move the most, because that's where the most value is. If you're really if you're buying, these very high priced tech stocks, that's where you have to be most concerned about which side retains the White House, because there's the least value there. The most value is in these sorts of stocks, which have not really benefited for the most part over the last 5 months, and investors are only just getting to them now.
Mm-hmm. Okay, well, great then. So let's wrap it up with what's your overarching strategy for this week, Roger?
Well, first of all, I just wanted to give my 5 cents on this argument you guys were saying, and I'll tell you something interesting. I looked at the last 50 years at when market gains most on Republicans presidents or Democrat presidents. And I thought the answer would be Republican presidents, but actually markets gain substantially more when Democrats take control of the White House. And I did not realize that, but they do. With that said, I do believe what Jeff, I take the side that Jeff Zaneri is taking. And I believe that in this case, it's going to be, because these two presidents are completely bipolar of each other. And I think in this case, I think right now with in the last couple of weeks, I think the Republicans' position has strengthened. And I think it's going to continue strengthening. And I believe the market would be better off because of the tax burdens that the Democrats want to put the country through. But with that said, again, I can't deny statistics, and statistics tell us that Democrats actually cause stocks to move higher than Republicans. And this is just statistics. This is not my opinion. With that said, my advice for traders is to be cautious. I think that the fast profits that we were able to capture post-February are now behind us. I think we're going to have to work a lot harder going forward. I anticipate the next month or two to be very congested, where we actually have a lot of volatility, but the market's not going to show a lot of direction, because there is such a difference in direction that the new president will take the country, if we do have a new president. But I think we have a lot of unforeseeability. My advice right now is to stay in defensive stocks. Jeff mentioned gold. I like copper right now. I like stocks that are related to copper. I like basic materials. I've been talking about FedEx and UPS. FedEx is the #1 stock in the S&P right now. And it has been for the last few weeks. I think the key is to stay away from politically sensitive sectors, and to stick with sectors that are defensive. Right now, I'm looking at animal care. Animal care is not going to go anywhere. People are still going to have pets, whether you're going to have Democrats or Republicans take control of the White House. So that's just to give you one example. But again, I think the key right now is to stay increasingly defensive. If you want to expose yourself to speculative sectors like healthcare and technology, do it with ETFs. your risk will be lower. Diversify yourself into some retail stocks like Nike potentially, or Workhorse, Lululemon, stocks that are actually moving higher right now, Gap. So I would stay away from the investment approach not the investment approach, but the companies that took us here from February. And I would look into more defensive companies, basic material, industrial, consumer staples, and so on and so on right now. I would be defensive right now.
Okay, and Jeff Z, what's your overarching strategy for the week?
My strategy for the week is I think Wednesday is going to be an inflection point. I think we're going to bounce into Wednesday, and I think we could see some vol that day and then the fall. So typically when you have a Fed day, the real move that's going to be the intermediate move isn't right after the Fed. So what happens is you get a lot of noise, static type of dislocation moves that happen in the last hour and a half of trading. What you'll see is that the move the next day following the Fed could have some legs and go for a week, a couple of weeks. And that's like what we used to call a new pathfinder. So you're finding a new path through the woods. Sometimes there's a tricky move that happens after the Fed where people think, oh, this is it, but it's not. So I would say if you're a trader, a short-term trader, wait till the following day, not immediate action after the Fed. I would always, by habit, habitually lighten up my book going into a Fed announcement just because of the insanity of a lot of the moves. I think you have to adjust your sizing with this increased volatility that we have, because you just frankly don't need the same amount of money to make the same amount of money, right? And I don't think a lot of people really go into trading or investments understanding what the risk tolerance is until they take one right on the chest in a bad position and they go, oh, wow, that hurt. I wasn't prepared to lose that much money, right? And so that's something we all have to learn for ourselves. But if you've had one of those experiences, take some chips off the table and play with smaller unit sizes, because you're likely going to have more of those experiences as we go on. That's just the reality of it. Like, you could hope, which isn't a strategy, that things are going to be different. But if you feel that way, you need to take that feeling out of your decision making, because emotional decision making in investing and trading is your enemy.
You bet. Hope is never a good strategy.
No.
Okay, Adam, what's your overarching takeaway for the week?
Yeah, stay with what's working. I think the tech stocks are still leading. I don't see any reason to get out because they've pulled back to support. Support is being defended. So if we see more selling in that area, I think this is an area to add to your tech stocks and your stay-at-home stocks. I also like undervalued stocks. The financials are doing very, very well. They look very, very good here. And gold is very, very good. And also the biotechs have been under pressure. And after a big move up, they've consolidated, and now they look like they're turning the corner and they want to move higher. So those are the areas that I would really be focusing on here, really going forward.
Okay. And Jeff Yasteen?
Yeah, I would just see what the market is doing through Fed Day, through Wednesday. I mean, if we rise into that, then I would be looking to, look to get short and buy puts perhaps. If we rise through that, especially if we get a nice pop with the announcement. Like Jeff Z was saying, a lot of it just depends on where things go on Thursday morning. But I would be letting that sort of dictate, the next move for the next, week and a half through the beginning of October at least.
Yeah. Okay, great. Well, nice, clear, actionable ideas this week as usual, gentlemen. I thank you all for your participation. Have a fantastic week.